Good evening, ladies and gentlemen. Welcome to the Federal Bank press conference post Q4 FY25 results. We have the senior management of the bank, Mr. KVS Manian, MD and CEO, Ms. Shalini Warrior, Executive Director, Mr. Harsh Duggar, Executive Director, and Mr. Venkatraman Venkateshwaran, Group President and CFO, and other senior members on the call today with us. I now hand over the call to Mr. Venkatraman Venkateshwaran. Over to you, sir.
Thank you. Good evening, ladies and gentlemen, and thank you for joining our earnings call. Firstly, I apologize for this delay, which was due to the delay in the conclusion of the meeting, and thank you for staying back for this earnings call. Let me begin with a brief overview of the macroeconomic and banking sector backdrop. The Indian economy remained resilient amid global uncertainties. This was also bolstered by stable domestic demand and prudent monetary policy. The RBI's repo rate cut and liquidity enhancing measures will help the economy focus on growth going forward. Inflation, as we all know, is now within the RBI band, and with increased liquidity, banks should be able to support the growth. Banking sector experienced intensifying competition for retail and MSME deposits. Asset quality remains stable with improvements in recoveries though challenges persisted in certain unsecured segments. Our bank navigated this environment by prioritizing growth in mid-market, mass affluent, and MSME segments to drive sustainable profitability. Turning to our Q4 financial performance, I'm happy to share a few of the major highlights. We crossed a total business figure milestone of 5 lakh crore, and 5.18 lakh crore was the figure as at 31st March, marking a significant milestone. And another milestone which we entered into is the 4,000 crore net profit league. Our other income soared to a new high of 1,006 crore, driven by robust fee-based services. Our focus on profitable growth ensured that our NIM improved by 1 basis point to 3.12% despite a rate cut, with nearly half of the book tagged to external benchmark. This showed our agility in a dynamic rate environment. Core fee income grew at 6% QOQ, outpacing asset growth, reflecting our team's alignment towards a more rewarding franchise. We achieved our decadal best asset quality, supported by strong recoveries and arrested slippages. Our slippage ratio continues to be well below the guidance which we have given. It's 81 bips. The guidance is to contain within 1%. This is a feat we have consistently delivered every quarter, even in a tough macro environment. Credit cost for FY25 was 38 bips, in line with our prior guidance of 35 to 40 bips. On the deposit front, we had a very strong story. CASA grew by 6.7% QOQ, while CA growth happened at a very healthy 27%. I repeat, 27% QOQ and 35% year-on-year. The focus on liability growth is yielding results. On the asset side, the focus on growing the mid-yield segment, like LAB, which grew at 20.5% year-on-year, gold 21%, and gold growth was 21% despite a bit of slowdown in Q4 due to some of the regulatory directions. Our microfinance portfolio grew at 19%, though we all know that in Q3 and Q4, we took a conscious call not to grow this given the external environment. CVC grew at 35% year-on-year, and the credit card business grew at 19% year-on-year. All this reinforces our diversified lending strategy. Our CRAR stood at a healthy 16.4%. And from a distribution perspective, we added 85 new branches this year, diligently expanding our footprint. Net profit for the quarter was 1,030 crores, up 14% year-on-year, driven by strong revenue growth and operational efficiency. Cost growth for the quarter had a few one-offs, and the OPEX to assets for FY despite that, is 1 bit lower than last FY. The OpEx cost growth this quarter, one-off included, distribution costs, credit, the campaign cost for cards, advertisement and campaigns, and a few related one-off expenses. Balance sheet grew quarter on quarter to 2.83 lakh crore, with CASA deposits at 87.5 lakh crore, up 6.74%, as I mentioned earlier. We also saw an uptick in our CASA ratio as compared to last year. It now stands at 30.23%. Our CD ratio was at 82.79% in Q4, ensuring balanced growth and liquidity. The focus on improving our LCR continues, with actions continue to be taken during this quarter. We degrew the wholesale deposits from financial entities, and our LCR has improved, and it's at a very strong and impressive 145 at the end of the quarter. Asset quality was robust, as I mentioned earlier, decadal best GNPA and NPA. GNPA at 1.84% and NNPA at 0.4%. Our provision coverage ratio stands at 75.37%, almost a 400 basis point increase over FY24. Credit cost for the year was 38 bips, and for the quarter was 26 bips, reflecting improved recoveries and portfolio resilience. Our capital position continues to be strong, with CET1 ratio of 15.04%, well above the regulatory requirements, providing headroom for growth. ROA was 1.24%, an improvement over 1.22 of last year. I will now hand over to Manian to give his comments. But before that, just before I do that, I want to take this opportunity to thank our Executive Director, Shalini Warrior, for whom this will be the last earnings call. Over the last decade, she has helped shape the bank's progress and achievements. And on behalf of everyone, Shalini, thank you so much. Over to you, Manian.
I'm sorry to interrupt, Mr. Manian sir, we cannot hear you. You're on mute.
Thanks, Venkat. Venkat has, of course, provided a detailed overview of our financial performance for the quarter. This is my second full quarter, and in general, my take will be that we have, by and large, stuck to our strategic priorities that we went public with in the month of February. And some of our key priorities that we had listed there, we have been able to bring to execution in the quarter. Of course, a quarter is a short time, and there's not that much change you can report within a quarter. But my belief is that the team is now aligned to executing the strategy in the form that we want it to. And whether it is to do with the liability side of the balance sheet, where the CASA growth has been reasonably impressive in the last quarter, and especially CA growth, significant momentum in that. The LCR position indicates the quality of deposits. While the deposits have grown, the quality of deposits have also improved through this process. On the asset side, again, in all our chosen areas where we had defined as medium yield assets, in most of those chosen areas, we have been able to show growth. There are specific areas where we need a more nuanced way of adding growth. For example, in the corporate business, while our asset growth is 8%, our fee growth and the liability and the self-funding from this segment has significantly improved through the last couple of quarters. And therefore, I would say that broadly, we are tracking to the priorities we set out for ourselves in our strategic plan. And without getting into more details, I would say we will open ourselves up for questions and take some of those questions, and some of the answers may lie there. Thank you.
Thank you. Thank you very much. Now we will go ahead with live Q&A. Before we go live with the Q&A, here are some points to note for your convenience. Members are requested to click on raise hands so we can allow the participant to interact with the management. You also have the chat option open to drop your questions. Kindly keep the questions brief and specific. After you raise your hands, we will call your name, post which request you to please unmute your audio and proceed with your questions. Participants who wants to ask a question, please press on raise hand option. The first question is from Informist.
Hi, sir. Kabir here from Informis Media. Just had a couple of questions regarding your cost of funds and yields on advances. While cost of funds and cost on deposits have been rising steadily, yield on advances has marginally fallen 8 bips. So, where do we see the trend going from here for those?
Venkat?
Yeah. The cost of funds is driven by several factors, including on the liability side, both SA and the term deposit rates. If you would have noticed that most of the banks have adjusted the savings rate post the second rate cut.
Right, sir.
And a couple of months back, when the first rate cut happened, there was still pressure on deposits, and none of the banks made any changes to the rates. But after the second rate cut, we have also started seeing banks adjusting mostly the longer tenor term deposit rates.
Yes.
So the deposit rates are now slowly coming down. It will take some more time for us to see a full impact of the rate cut on the deposits. Secondly, the regulator RBI has taken steps to improve liquidity in the market, which wasn't the case a month back in terms of liquidity. So that will also help in terms of adjusting the cost of deposits. On the asset side, on pricing, yeah, this is something which, as I said earlier, we have been working to ensure that we protect the NIMs to the extent of ensuring we pursue profitable growth and focus on those medium yielding assets. And some of those conscious calls which we took, we'll continue to take that on the asset side and grow the chosen segments faster vis-a-vis the rest of it. So with a combination of all this, we do expect to balance the impact on the NIM and ensure it doesn't see the full impact of a rate cut.
Right. So the NIM we are expecting to maintain at the current levels?
There will be a range at which we will operate, and we'll also have to keep in mind the growth factors, which once the growth is back and we see opportunities to grow faster than what we are seeing now, I'm
Yes,
sure
sir.
we will start seeing the impact of that as well play on the margins.
Thank you, sir.
Thank you. The next question is from the line of Hamshini Amrita from Money Control.
Hi. Hi. A couple of questions I have, sir. So the bank's yield has been a little trending on the downward side. It was close to 9.5. We're tracking 9.1 now. A couple of banks are also, similar sized banks are also seeing pressures on yield, and they're moving to high yielding and also possibly high risk products like used cars, used CV, etc. Would you look at a strategic change to your asset mix in order to bump up yield in the face that you expect some bit of margin compression to offset this up?
So, Hamsini, as in our strategy document, we have laid this out quite clearly.
Right.
We have called what we call the medium yield assets. While we don't want to, currently it is not the environment to really, we do have a microfinance business, but this is not the environment where we want to press the pedal on the very high yielding products. Having said that, if you have noticed this quarter itself, our credit card, one of the higher yielding products, we have already started seeing traction. We intend building some traction on the personal loan side, which we have till now not done in the year, but we see the credit environment getting better to accelerate that. And our medium yielding products did include products like you mentioned. In our CV business itself, if you see, we have grown it much faster this quarter itself. And we also intend to add used commercial vehicle proportion. There is some used commercial vehicle we do intend increasing the proportion of that. Similarly, on the car side, we are also looking at increasing the proportion of used cars. So there are multiple levers that we are going to use within our risk return frameworks that we are comfortable with. We will use all the levers that are possible to protect our NIMs to the extent. It is like Venkat mentioned, it is undeniable that if there are significant rate cuts that happen with more than 50% of our assets linked to repo, there will be downward pressure on the yields, and we will need to do some balancing of that as we also balance the cost of liabilities. And one more thing that I would add to what Venkat said is also the mix. As you can also see in this current quarter, we have tried and grown our current account faster, which also has a downward cost implication on cost of funds. So it's a multiple moving parts on the NIM and the yield on the assets and cost of funds. We have to be agile and react to the situation as it emerges, and we are quite confident we'll be able to do that.
Lovely, sir. So I have two more questions, and I should have started with this. Congratulations on a fantastic milestone of 5 lakh crore of book. That's a big achievement. Where do we see the bank from here on? You had also made a lovely presentation a couple of months back on your longer term strategy. There are candidates which is opening up for acquisitions, or rather they're offering themselves for acquisitions at a much better price than what we saw 2 years ago. Would you look at some part of it? And specific to the gold business, there are a lot of opportunities which is coming up now. Would you look at any of them, given that business particularly is your strength?
So, Hamsini, again, of course, these are possibilities. As we have stated in that document, strategy document, we will remain open to inorganic growth. Having said that, there is nothing on the plate today, and there is, as and when we do spot an opportunity and find a transaction which is value accretive for us, we will remain open to do it.
Lovely. One last question, sir. For Federal Bank, deposit rates have not been really the make or break factor in attracting deposits. But having said that, the industry is tracking downwards on deposit rates, primarily on SA at various levels. FD rates are still yet to adjust so much like SA rates. What is your commentary on this, sir? How much do you believe at Federal you have a range or a bandwidth to play around with deposit rates?
No, so we did make a call middle of April, 17th of April, to cut our savings rates as well. Our savings rates were also cut. And we also cut deposit rates through the month of April, not till March, but in the month of April, we have cut term deposit rates as well. Finally, we will react to the market and see how the market behaves and decide our strategy. I think we do not want to. We are clear that we have a reasonably strong franchise on the savings account and customer acquisition side, and we do not believe that we need to really play an aggressive savings rate game at this point in time. We are quite confident that the franchise has enough attraction and ability to attract deposits and continue to grow our deposits without doing any aggressive rate strategy on the savings account side. On the term deposit side, we will benchmark to the market and pay what the market leading players in the market pay.
Okay, sir. Thank you. And it's also lovely to see that, at the year end, usually when a new CEO steps in, there is a reasonable bit of kitchen sinking that happens. That's not been the case with Federal. That's heartening to note, sir. Thank you. I'll connect with you soon. Thank you.
Thank you.
Thank you. The next question is the text question from Ashish from Press Trust of India. And the question is, what is the credit growth target for FY26 and any outlook on the NIMs?
We have always stated that our credit growth will be in the range of 1.2 to 1.4 times, 1.5 times, in that range, 1.2 to 1.5 times the nominal growth rate, GDP growth rate, right? That's where it continues to remain. We are reasonably confident that we will be able to that kind of growth rate. In our, like I said, of course, we are choosing our areas of growth, but I think on an average, we will get there. On the NIM, I already made a commentary. It is multiple levers, multiple factors at play. No denying that there will be downward pressure if significant rate cuts happen over the year. We'll have to, like I said, do measures on the asset side and liability side to manage NIM. There is no particular guidance we have at this point in time. We will remain agile is the only way I would put it.
Thank you. The next question is from Chandan Pednekar from Prahar. Please go ahead. Chandan Pednekar, we would request you to please unmute yourself. Sorry to interrupt you. We are unable to hear you, sir. Mr. Pednekar, we are unable to hear you.
Maybe you can go back to him slightly later.
Go to the next
one and then come back to him if his connection is better at that time.
Yes, thank you. Participants who wants to ask a question may raise their hands.
There is a question in the chat. Shalini, you would like to take that? Fluctuations in rupee value has any impact on your NRI business?
Yeah. So good evening, everybody, and thanks for that question to Sunish Bhasi. So typically, what happens is in an environment where interest, where the rupee rate is fluctuating, there is an impact on the NR business. It works either way. Either you get remittances out or remittances in. Having said that, and I want to come back to what Manian said, our core purpose in our savings account, including our NR savings account, is much more than either interest rates or fluctuations in interest on rupee. Our core proposition is around the customer value proposition that we give. So honestly, fluctuations in interest rates may have some impact on NRE term deposits, but our savings account rate remains very robust and resilient and is driven more by customer value proposition and product features.
Thank you. The next question is from Saloni Shukla.
Yeah, hi, am I audible?
Yes, hi,
yes, Saloni. Yeah.
Hi.
So just wanted to understand on both on the retail and the corporate side. I heard the presentation that you made to the analysts. So, obviously you have sort of outlined what the strategy of the bank would be. To focus on more high yielding assets, but also, risk, reward, return and all those things. But any specific segments in retail that, you want to focus for the coming year, especially in line with, whatever we are seeing in the macro economy? Can you give some sense on that?
So, Saloni, on the retail side, there are all products, including cars, cards, LAP, auto. all of those are clearly areas in that what I call the mid-yield region, mid-yield assets. And if you look at the growth rates of LAP, auto, all of them have been reasonably good in this year, right? So the home loan is an area which has grown relatively slow.
Yeah.
Like I said, I think home loan we have to find the right nuancing on growth on home loan. We are looking at more customer holistic relationship with the customer for our home loan business. Standalone home loan strategy is something that we want to not be in that hyper competitive standalone home loan kind of a strategy. We are looking at an overall customer relationship, and if we get multi-product relationship and a holistic relationship, we are wanting to grow the home loan. So in that sense, the entire gamut of retail products, we are still small on most of them. Even on products like commercial vehicle, which again has grown very fast, even in this quarter, is clearly an identified area of growth. So I would say, from our point of view, the opportunity to grow, given where we are today, is fairly wide across products. And on the corporate that you mentioned, I must give you one point on corporate. Again, almost 75% of our new acquisitions this year have been in the mid-market in the corporate.
Okay.
And so we want to remain focused on value accretive business there. And just to tell you, our fee growth as well as CA and liability growth from the corporate segment is significantly more, not slightly more, significantly more than the asset growth that you are seeing there. And that's the way we want to look at the overall customer relationship and RAROC-based approach to corporate relationships. And so we do think that also can be grown as we build our mid-market segment, which is, and you can also notice in our results, the commercial bank has also grown, which is the low-end corporates, has also grown at late 20s, right? Close to 30% kind of growth rates. So we see opportunity for growth almost across the board in all areas.
And on unsecured, sir, all the banks which have posted earnings so far have, none of them have actually spelled out that concerns have receded in this segment. So I'm assuming that, this segment is still to peak out in terms of asset quality. What would the understanding from you be, sir?
So from our point of view, the understanding is as follows. I think microfinance, we would like to wait more. We are not yet seeing clarity about improvement in the asset quality there yet. So I would say microfinance is still wait and watch for us. Having said that, the personal finance side, the personal loans and credit card, as you will notice again in our results, credit card has grown reasonably healthily in the last quarter and in the year actually. So we are seeing possibilities of growing the PL business, which we had not grown last year. Probably this year we will be able to grow our personal loans business more than we did last year. And therefore, I would say on the personal unsecured side, we are beginning to feel more comfortable. We will not jump into it, but we will at least begin to build that business, that side of the business. Microfinance, we'll still wait.
Sir, on margins, you were one of the earlier banks, along with HDFC and ICICI to bring down your savings account rate. So was that, a maneuver to sort of balance the margins, or because, deposits on the longer run are still, you're paying higher for
Yes,
it?
absolutely. Like I mentioned slightly earlier, I think to protect NIMs is a strategy both on the asset side and liability side. And the liability side strategy includes term deposit rates as well as savings rates. And we were reasonably agile, as I said. So I think managing NIM in an environment where there could be aggressive repo rate cuts over the year needs us to be agile, and we will remain agile and react with the market.
Okay, thank you so much, sir.
Just to add to what Manian said, the savings rate reduction has happened only in April, so it's not reflected in the last quarters.
Yeah.
Thanks a lot.
Thank
Thank you. The next question we have got as a text question, which is from Narayan from Financial Express. And the question is, what is the reason increase in fresh slippages in agri and retail segments? What is the recovery for the full year?
Venkat, do you want to take the details of this?
Yeah, on the fresh slippages, agri retail, one of the main reasons is, like we said, we are seeing the stress in the MFI portfolio still continue, and it hasn't bottomed out. And we believe it will take probably a quarter or two more to see that bottom out. That's the main reason for slippage increase in that particular segment. But having said that, overall our slippages for Q4 is lower than Q3, and the recoveries are at the highest ever recovery which the bank has had in its history. So we have managed to make sure that the credit cost is well contained.
If I can just add to that, Venkat, and if you look at one of the slides we have in the investor deck where we do show the breakage of the slippages between the different segments, you'll actually see that retail is trending downwards in Q4 because credit cards and some of the other products which had peaked a little bit between Q2 and Q3 has started moderating now. We have consciously not done much on personal loans because we recognize there is stress in that. So to that extent, retail is. Some of what you see in agri, and I'm sure Harsh can add to that, includes MFI because that would potentially be, some of it would be in that piece also. So you will see some of that, and Manian alluded to that it might take another couple of quarters before we can see the plateauing or the bottoming of the MFI slippages. So it's a mix of it, but overall, as Venkat said, we do believe that both GNNPA and NNPA are at, as we said at the introductory remarks, are at a decadal best.
Yeah, and agri has remained flattish. Microfinance, while there has been some green shoots in terms of collection efficiency improving month on month in the quarter four, but it's too early to come in, and you would like to wait for another 1 or 2 quarters to see how it shapes up.
Thank you. We have a next question from Gurudat Tiwari from Dainik Bhaskar. And the question is, what does MD think of current banking environment and what is outlook for this coming year with all these troubles in global market?
So broadly, I am positively inclined towards the outcomes in this environment. I think it's a reasonably positive situation. I think while, of course, the tariff war is an uncertain phenomena and nobody knows where exactly it is headed and how it is headed. But my fundamental belief is that Indian economy, as always, has been more domestic oriented, and therefore its linkages to and impact the trade share in general for India has not been that significant if you keep oil aside, and therefore the likely impact of tariffs on India is likely to be lesser than a country which is far more externally linked in terms of trade. So in general, I am not, while of course it will cause some uncertainty, in general I am of the belief that India will be able to navigate this tariff war or tariff situation reasonably well, and we will see reasonable growth. I think we will continue to see reasonable growth, and I am optimistic about the overall banking environment, given, of course, banking environment is a derivative of the overall economic environment. And since I see a reasonably positive economic environment, I am optimistic about the banking prospects of the banking sector in general. I hope that answers.
We have the follow-up question from Mr. Gurudat Tiwari, and the question is, what type of challenge banks are facing in current market scenarios? As after high growth year after COVID, it is very difficult for bank to grow in that pace. Same time, fintech and small finance bank posing big challenge for traditional bank.
I don't particularly entirely agree with you in the sense, yes, there will always be competition in the market. I mean, there is no time where you will not have competition. In a growing economy like India, and if the growth sustains, I think there is place for all kinds of players, whether fintech or for banks. And I think all banks have to choose their turf to play and their act to play. And I'm sure many good banks are doing that reasonably effectively. And I do believe that a bank like us, with a great heritage and a reasonably good franchise, which is growing across the country, has an opportunity to play in this environment.
Thank you. The next question is from Anshika Kashyata from Mint.
Hi, good evening. So, wanted to get your view on the recent RBI norms on gold and co-lending. Do you see some impact on the gold loan portfolio as you recalibrate as per the new norms? And on the co-lending side, now that you have the option to go beyond PSL, partnerships will be looking at more sort of co-lending in maybe some other retail segments.
Right. I'll ask Harsh, my colleague, to take that question. Harsh.
Yeah, hi, Anshika. In the case of gold, there are obviously the draft stage, but there are a couple of things which are quite favorable, and we're looking forward to it. Number one, in terms of renewal, there's complete clarity as to what can be done for gold renewals in the standard stage, which was a little bit more stringent earlier. Secondly, there was an advantage with some other regulated entities compared to banks in terms of maintaining LTV during the tenure of the loan. They were required to do it at the origination time and not during the entire tenure of the loan. This has been made uniform. And third and most important, I think RBI has very categorically decided between income generating and for consumption purposes. So for income generation for banks in particular, if it can be done, while yes, assessment has to be done and end use has to be monitored, but the LTV guidelines would not be applicable. So all in all, it's definitely favorable, and we're just awaiting for the draft guidelines to be final for us to take the benefits of that part. So it'll be definitely a beneficial for the banks and for us, because we are amongst the largest players in the gold segment in the banking industry in the private sector. We are hoping to look forward to gaining from that part. On the CLM piece, definitely there are two clear advantages. One, it's not just PSL, it's non-PSL, it's all kinds of assets. And they're opened up to more entities. Most importantly, there are two things which has come in. It's not just 80-20, which was there earlier. The ratio can be even 0-100 because it can be for sourcing and servicing as well. So that's the one good thing which has come up. Secondly, there's also more skin in the game through default loss guarantees, DLGs, which was not there earlier. So these are the two positives which are also there, apart from the others which you mentioned. We are just waiting for the draft guidelines to come on this one. Yes, there's one thing over here. It will definitely require far more integration from the tech side between the bank and the partner so that it can be ensured, because it will be more of CLM1 rather than CLM2. So that would require a little integration. So we are awaiting the final guidelines and then choose the partners accordingly.
Got it. Thank you so much.
Thank you. The next question is the text question from Athira from Business Standard, and there are two questions. First question: considering RBI's draft proposal on multiple entities doing similar business, which notified in October, what is the bank's plan for Federal Bank Financial Services? And the second one is, since the bank already has a presence in the life insurance, is it planning to enter the general insurance industry?
So on the first, of course, we will await RBI's final word on that before deciding our course of action. So just now it is a pause on what can be the options. So we don't have any particular view on the matter just now. And on the second, we don't have any immediate plans to get into general insurance business.
Thank you. The next question is from the line of Malvika Sudarshan. Please unmute yourself.
Hi, am I audible?
Malvika, there's an echo from your line.
Hi, am I audible? I'm sorry.
Yeah.
So we've recently observed that a large bank has been going slow on foreign remittances and allied services recently. Has this led to, has this helped Federal Bank incrementally in the last 30 to 45 days as a result?
Harsh, you want to take that?
I didn't get the question. Can you repeat the question, please?
On inward.
I don't know which bank Malavika is referring.
And inward remittances or outward remittances also, Malvika?
I didn't, because you're talking about inward remittances coming into India from that point of view.
Yeah, that's correct.
Okay. So then,
Shalini,
Shalini, you want
Shalini, you
to
want to take this?
Yeah.
Shalini, you want.
So, I'm not privy to the details of the specific instance you're speaking about, Malvika. But generally speaking, I can tell you from a remittance business standpoint, we do have a commanding position. As you know, we've always had between 18 and 20% market share in that. Over the last couple of quarters, we've been focusing on growing our business penetration into existing partners and also identifying new partners, particularly in the non-GCC geographies. So we have a couple of partners going live in this quarter, as well as in various stages of integration over the next 6 months. So our strengths in that business lies from a combination of relationship management, technology, operational support. Bringing all that together, we are well positioned to be able to gain market share in this industry. We understand this business very well. It's a good feeder to our non-resident Indian business that we do very well. So taking all that into account, we are quite bullish and investing in growing that business further. Like I said, I can't comment on the specifics of the bank, Malvika, but I can give you our perspective on it. Yeah.
Sure. Thank you.
Thank you.
Can we take one more question
Yeah.
and then?
So that was the last question
Right,
for today.
Right. Great.
Right.
Okay.
I will.
Thank you very much. Thanks everyone for joining us today. We really appreciate it. Thank you.
Thank
Thank
you all.
you, everybody. Thank
Thank
you.
you.
See you. Bye.
On behalf of Federal Bank, that concludes this conference. Thank you for joining us, and you may now disconnect.